I can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, what Bank of America just said is outright shocking. I can't believe that they've made such a claim. And this is why, if you're wondering, why we're outside the Bank of America building here in New York, is to get the real story. Because when you hear what they said, and I show you the facts, you will not believe they made such a claim either. And we're also going to have to talk about what's going on with the U.S. Treasury today, because they've announced officially they're going to raise the amount that they need to borrow at their upcoming auctions. This is causing some pandemic in the bond market. But what's the real story? Well, we've got that for you as well. Now let's head over to Bloomberg, because I want to give you some little backstory before you hear what B of A just said. Traders are risking it all on bets that the market boom will last. And many people keep saying, but the stock market keeps going up. And what I want you to understand is that people are buying stocks. They see the market go up, and so they buy more of them, causing the market to go even higher. And as they see the market go up, not translating that it's actually just investors chasing the market higher, they think that the stock market is actually telling us something about the economy that the data doesn't suggest is true. What once was a posture of skepticism among investors has morphed into something approaching euphoria, and that's for sure. Cash and hedges are out, replaced by demand for everything from small caps to meme stocks. And fueling the surge is data showing the U.S. economy is thriving. Amid mounting evidence, the Federal Reserve is beating inflation. In fact, there's the real underlying story is we all now have faith in the Fed that the first time in history, and mind you, the Fed has a terrible track record of tightening monetary policy and getting away with it, because usually what follows is a recession or something worse like a financial crisis. But this time, everybody's buying into it, and what they want to do is front run the next expansion because they think the Fed's got it right. All the optimism has sent the S&P to the brink of its sixth advance, of course, excluding today. And NASDAQ 100 is trading almost 35 times profit, and it's manna for bulls, even as it leaves them with precious little wiggle room. And this is the key part here. Should anything in the economy or monetary policy not unfold as hope, and that's what we're going to show you today, that all of this hope is really dashed by the real data underneath that says the economy is in a bad shape. Of course, Bank of America, wait till you see what they had to say. But it's dangerous and consensus, but it's late July, so who feels like fighting it? We're now at a stage where people feel obligated to fully commit capital. A hawkish Fed is not an excuse right now, and claiming recession is hard to justify as well. Now, you'll remember what investors believe is this phrase of don't fight the Fed. So if the Fed's easing by cutting rates and doing quantitative easing, well, that means you should buy stocks. And if the Fed's tightening by raising rates and doing quantitative tightening, which they're both doing now, well, you should be selling stocks. In terms the actual opposite is happening. It doesn't matter what the Fed is doing. The problem is when you see stocks going up, people buy more, and then they see them go higher, so they buy more, and then they start to believe that the stock market is a sayer of truth when it's really not. And here's one of the reasons why we like to talk about the net percentage of domestic banks tightening standards for commercial industrial loans, this to firms of all sizes shown in blue. And as you know, if you watch the show on a regular basis, that anything above the horizontal black line means on net banks are tightening standards when it's going higher. And even when it's coming down, it just means fewer banks are tightening standards. It's not until it goes below the black line that they're easing. So when we start to talk about what everyone is missing in terms of the next big bull market, is they're not looking at the money centers, the banks who create money in the economy. Because if you want the stock market to go higher, what do you need? People who can pay higher and higher prices, driving the price of shares up. And if there's not enough money being created in the economy to drive stocks higher, well, at some point, it starts to get real heavy and head down. And here you can see the evidence is strong that suggests as banks continue to tighten lending standards, we're overlaying the Wilshire 5000 price index. This is the total U.S. stock market. And you'll notice that it starts to head lower there in the dot-com bubble. Happened again during the global financial crisis. But this time, investors, they believe it's different, but the outcome will be largely the same. And the Treasury market has lately seen fast money short bets expanding, with hedge funds overall pushing up bearish wagers to historic levels. Even leverage funds have been boosting overall shorts on U.S. bond futures since March, according to a gauge of aggregate net positions based on data from the Commodity Futures Trading Commission. And this would make sense if you really believe the Fed's got this right and the market's going to go higher and the economy is going to expand. Then what should happen is the yield curve, remember we talk about this all the time, should uninvert. But how should it uninvert? Well, it would have to be with long rates going much higher, and that's why you see such outrageous bets on the bond market right now. Here you can see loading up on those bearish bond bets. This is from the latest CTFC data, which does not include what we've seen trading this week. So you can pretty much bet that these positions now at historical extreme levels are even worse. There you see on this chart, at least since 2016, but this is probably the record short position on treasuries. And what this means is fast money quants, known as commodity trading advisors or CTAs, have been amassing a huge short bet since May. Of course, according to JP Morgan, what they say is estimates are sitting on a whopping 150 billion short bond position. And here's the key word, that they may unwind in a rally. Well, if you understand how machine positioning works, and we do, what I can tell you, in a rally, they will unwind those positions in a major way at a time when treasury liquidity still remains fairly low. So all this suggests, and I want you to see the setup here, is how investors are positioned, what they view the economy as like, and now let's take a look at what Bank of America has to say. BofA joins the Fed in reversing recession call amid growing optimism. And here you can see one of the issues here. We know a lot of the big banks, their analysts have been saying, hey, you know what? We're pretty bearish here. We're bearish. We think the economy is going to recess. We think the Fed's got it wrong. We know the historical data. And now all of a sudden they're looking at the stock market and saying, well, you know what? I'm going to throw in my towel. And I can't believe they're saying this, because as we get into the data here a little deeper, you're going to say the same thing is, what are they seeing? Well, what they're seeing is the equity market go up. And one thing that should be going up with stocks is your trading account, because if you signed up for CTA-Timer Pro, this is our mimic of those commodity trading association machines. The only difference is we run it on with a historical overlay on top of the machine positioning. Here's an update on our soybean trade. We showed you this one a while back. This was the entry point at market open here, and now we have what would look like, I'll show you on the report, a closing out signal at market open today. How'd you follow the report? A 10.7% trade to the upside in a 2-month period, because here you can see on June 9th, they were short covering from that max short position, which subscribers know we love to look for those reversals, because that says the machines are going to chase this thing higher. Here you can see it today on August 2nd. The machines are starting to now sell down and go short, suggesting it's time to exit that position. And sure enough, that would have led to a 10% gain in 2 months. And when you sign up for the report, you'll see on a regular basis, it finds phenomenal trades. Now, they're not all perfect, because no report is, but when you follow the way we show it to you, as you'll see here from a lot of subscribers, they're getting rid of their other subscriptions and relying on this one. It's $30 a month. Check out the link in the description. Now let's get back to BofA, because I still can't believe that they're saying now there's a chance the recession is over. Let's take a look. The change comes just after a week after a Federal Reserve Chair Jerome Powell told reporters that the central bank's own economists are no longer forecasting a recession. Of course, we can note that the Fed is terrible at forecasting recessions, because they've never actually accurately forecasted one to begin with. But now again, here we are, everyone's buying into it. Recent incoming data has made us reassess our prior view that a mild recession in 2024 is the most likely outcome, now pushing it back to next year for the U.S. economy. This according to BofA economists. Growth in economic activity over the past 3 quarters has averaged 2.3%. Of course, if you like lagging data, the GDP is a great one to look at. The unemployment rate has remained near all-time lows, which I'm going to show you based on the day-to-day. That picture is going to start changing, and wage and price pressures are moving in the right direction. So I want you to understand what the view here is, that the Fed is actually going to bring inflation down to the level that is considered nominal. Maybe it'll be around 2%, maybe a little over, a little under, but they're going to get to their target. And at the same time, the labor market is going to stay strong, that nobody's going to lay off. everybody's going to keep their jobs, they're going to keep their hours, they're going to keep making money and spending it into the economy, and that is the holy grail of monetary policy. If a Fed chief can pull that off, they will be elevated in history to among the greatest, if not the greatest, central banker the world has ever seen. But is that likely to happen? Well, no. And here you can see on this chart the consumer price index shown on a year-over-year rate of change in blue against the 4-week moving average of initial claims. Now, I'm going to set this up and show you a little bit later in the show the catalyst behind all of this. But what I want you to see is that large drops in inflation, this since the 1980s, are followed by an increase in initial unemployment claims, this being the 4-week moving average shown in red. So you'll notice that generally large drops and even some other ones that are just brief drops usually lead to an increase in unemployment. You see it happen over and over again, particularly going into recessions, which are noted by those green bars or gray shaded bars. And here we see the signs again, because inflation just isn't a matter of prices coming down, which is how people view it. What it's a matter of is demand. So when demand goes down, then price pressures also abate. It makes perfect sense. But one thing that really causes price pressure to abate is when people lose their job, because when they get on unemployment, their wages go down. They don't make as much money on unemployment. It's not like the pandemic where people were off work and had more money. That's not the reality. So as people lose their jobs, they have less money to spend in the economy, and that brings inflation down. And next thing you know, you get the full circle. Of course, the Fed says that this red line is not going to keep going up, and I'm going to show you a little bit later why it is. The resilience of the U.S. economy this year, despite the most aggressive Fed tightening cycle in decades, has forced many on Wall Street to repeatedly revise their forecast for when the country will fall into recession. And again, this is where I struggle with, because with the recent data showing persistent strength in hiring, we're going to look at that in a moment because we got some new data on that today. Alongside moderating inflation, forecasters are beginning to rethink their recession calls altogether. And I don't get it, because the data is pretty clear. The economy is slowing down. We can look at all those historical matches and see that, yes, everything's pointing to a recession here, but the narrative now is switching because the stock market's up. Let's take a look at the job openings and labor turnover data. This came in yesterday, and here we can see there's 9.58 million job openings in the U.S., but that's not the number that's important here. It's the trend, and I want you to see this as we're going to dig a little deeper into this chart. But you'll notice that going into recessions, again, those gray shaded bars, what do you see with the jolts? The trend is falling. So here we see that again, but let's look a little deeper of why everyone says this is a good number. Because what it says right now is 1.61 job openings for every unemployed worker, meaning there should be no reason anyone's unemployed. In fact, it even goes as far as saying, if you want another job, you should go get one, because it means they're probably going to offer you a higher wage. And this is what the Fed is looking at, thinking there's going to be this wage price spiral. There's too many job openings, not enough workers, and that means they're going to chase wages up, when that's not exactly how it usually ends up playing out. And here we can see that perhaps there's some question to the accuracy of the survey right now, because a mere 31.2% of firms polled bothered to respond, well below the typical 70% average that the report generally sees. But look at this, because now we're going to overlay the Wilshire 5000, and I want you to see that it's pretty unusual you see such a nice relationship, but when you look at the job openings and the stock market, you see a very nice relationship, suggesting that as job openings go down, and again, it doesn't matter from what level, as they go down, it suggests the stock market is heading down, because it tells you demand is falling. If employers are pulling job openings, it means they don't need as many workers, and that means demand is falling. And I want you to look at these two periods that I circled, because you can see some divergences in where the market's wrong. And again, this is where I think those B of A analysts are missing the mark. And here you can see going into the pandemic, job openings were already slowing. The belief at the time was we were headed into a global recession to begin with, and then the pandemic shows up. But look at this. The stock market in red continued higher until it reversed picture. But now look here again. The stock market is going up, job openings are falling, suggesting that one of the two is wrong. Either job openings need to go up, or the stock market needs to come down, perhaps like we're seeing to see today. And yet, what go on to see that there's a fine line between a mild recession and a soft landing is increasingly fine according to sentiment, and this is echoed by others in the recession camp. In fact, a recent survey of business economists showed a strong majority now say the odds of U.S. entering recession in the next 12 months are just 50% or less. In fact, even Cleveland Fed President Loretta Mester nodded to the change in tune among businesses in her region. At the end of 2022, she noted, many of our business contacts were telling us they expected the economy to enter a recession this year. Now, she says, most think there won't be a recession this year. And what is driving that change in sentiment? Well, if you said the stock market, you got it right. Let's take a look at the University of Michigan Consumer Sentiment Survey, that's shown in blue, and we've got the Wilshire 5000. Now, I put it on a year-over-year rate of change because you can see the relationship a lot better here. In fact, as the stock market tends to go up, consumer sentiment tends to follow, as well as business sentiment, because when people feel wealthier, what do they tend to do? And if you said spend money, you got it. But what happens when they don't? Well, that means the stock market is front-running a rally in sentiment that doesn't translate to spending. And next thing you know, you're talking more about a reversal in the equity market than you're talking about a new bull market. Again, causing baffling decisions here by B of A to yank the recession call. But yet the backbone of the economy and its resilience is the labor market, and everyone continues to get stuck on this as low employment, steady hiring, and solid wage growth have given American households the wherewithal to keep spending. Legislation championed by the Biden administration is also giving an unexpected boost to economic growth. I'll let you decide if you believe that in the comments below. A trend that could add to reasons why a U.S. recession may be delayed or even averted. And remember, when we talk about the labor market, it's a lagging data series because employers tend to hang on for employees for a while. They'll first cut their hours and then they start cutting jobs. And so the question here is, why aren't they cutting as fast? Well, because they already went through that during the pandemic, and they too believe in this second half revival story. So they're holding on to their employees, hoping that demand turns around. And when it doesn't, watch, they're going to lay off. In fact, we just got the latest report from ADP going ahead of the non-farm payroll report coming on Friday as manufacturing sector loses jobs for the fifth straight month. ADP report shows even wage growth is slowing here. Following the weakness in the ISM PMI data, which we actually showed you in the show the other day, they noted there was a slowdown in ADP's number, but get this, it printed a better than expected 324,000 jobs in July, and that's a big number because we should be seeing likely lower numbers. But I want to show you where it's coming from here, because remember, the new narrative is services will lead manufacturing, but check this next slide out. Here we can see manufacturing jobs in light blue trending down, services jobs heading higher, and what we can note is where manufacturing goes, you see it heading down, services follows with a lag as we've been maintaining for a long time. And where are these jobs being created? Well, they're being created in the leisure and hospitality space. And as someone who lives in literally the vacation destination, the capital of the world, where everybody wants to go, I talk to a lot of the workers here every time I go out, and they're telling me that demand here is falling. There isn't as much work, there's not as much hours, and yet there's still some hiring going on. But here's the key point. These are low wage jobs. These aren't something you raise a family on. These aren't something you buy a house on. These are low wage, entry level jobs. And yes, the minimum wage has gone up, but that doesn't change the bigger picture. So as we look at this report and everyone says the labor market's booming, well, it's booming in low wage jobs, which is not what we need as the manufacturing sector lays off. And we can see that the damage being done by the banks is going to cause the layoffs. And so we go back, if we could go back and overlay the consumer price index on here, which I did not do, what you would note is there are periods where the consumer price index comes down and it doesn't cause a recession. But when you actually factor in the banks tightening lending standards as another factor to the model, what you see is that's what causes inflation to come down, which we've shown you in past shows. and it causes unemployment to go up, because it's all the simple case is there isn't enough money fueling the economy. It's being starved. And when you do that, well, there isn't enough money to keep the growth going, to keep demand going. So you need less and less workers. And what's notable about this happening, it's at a time when the government is running massive deficits and looking to borrow in a big way, which is putting the bond market in a bit of a tizzy. But will it last? Probably not. As Fitch's U.S. credit downgrade sparks criticism along with unease, but really it doesn't matter, because pushing back hours before her department is set to ramp up its borrowing to plug a ballooning budget deficit, Treasury Secretary Janet Yellen called the downgrade arbitrary and outdated. The economy has recently shown signs of resilience, and the debt limit was ultimately lifted, she said. And really, it doesn't actually matter, because nobody cares right now about our value of our credit rating being downgraded. What matters is, are people going to keep buying our debt? As the U.S. plans $103 billion debt sales as issuance to keep rising, Treasury said it will sell $103 billion of longer-term securities as so-called quarterly refunding auctions next week, which span 3, 10, and 30-year Treasuries, up from $96 billion total the last time, suggesting that many believe nobody is going to buy this debt. And part of that deterioration is thanks to higher interest the Treasury now pays. The Treasury said its tax receipts have been weaker. Wait a minute, weaker than expected, suggesting the economy is indeed slowing down here. And at the same time, the Fed's running its quantitative tightening program, which in theory should cause rates to go up. But one thing that's interesting here is normally you see, and I've got federal debt here shown inverted, as the government takes on more debt, interest rates tend to fall. And the reason that happens is because the government's pulling more money out of the economy. And at a time when the economy is slowing, well, what does that do? It pulls away from the growth engine of the broad economy. It actually acts as an accelerant to the downside. And so right now yields are rising. We can only now know that those are going to get reversed. And here's another slide we can look at as federal government current tax receipts shown in blue on a year-over-year rate of change. We can note when they go down, and you can see that usually yields are falling, suggesting the economy is slowing. Right now the Fed is raising rates, and I said investors are betting on this next bull market. And of course you can start to see why B of A pulling their recession call makes absolutely no sense here. Why investors are lined up for the next bull market makes absolutely no sense here. And what's going to be shocking is when the whole thing goes in reverse, and that's coming in the not too distant future. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.